$1.3 trillion in paper, that's what they call stable. The figure isn't tucked away on some Fed ledger, it's coursing through the arteries of the global finance world right this second. $1.3 trillion in commercial paper, unsecured notes that firms use to pay wages, stock shelves, and fund next quarter bets. It's the dry powder of corporate America, the grease that keeps the commerce gears humming, or at least that's the story we've been fed. But here's the rub: $1.3 trillion isn't merely a number, it's a powder keg. Last quarter, Morgan Stanley alone had $42 billion of that paper maturing in the next 90 days. That's not pocket change. It's 42 billion reasons why the upcoming refinancing window could slam shut, and why the folks banking on stable paper might wake up one morning to discover they've been clutching IOUs written in invisible ink. Beat text pop. Morgan Stanley's $42 billion due in 90 days source, Sec 10Q Q1 2024. That's not just a balance sheet line, it's a ticking clock, and it isn't only a U.S. dilemma. The Bank for International Settlements recently warned that $1.1 trillion of this paper is dollar-denominated debt issued by foreign banks now forced to roll over those loans in a currency that's growing stronger by the day. A stronger dollar translates into heftier debt payments. And heftier payments mean less breathing room when the music stops. Beat Zoom. Which brings us to the illusion of stability, because the dollar isn't simply strong, it's deceptively strong. The Fed assures us the system is sound. The IMF says a 5% dollar appreciation could shave 3% off global GDP. That's not a forecast, that's a euphemism for collateral damage. Beat visual. Picture this: you wake up tomorrow and the world's biggest corporations can't roll over $1.3 trillion in short-term debt because the commercial paper market just froze. Picture foreign banks scrambling for dollars to settle their bills while borrowing costs skyrocket. Picture a liquidity crunch so brutal it doesn't just rattle the stock market, it snaps the chain that links every dollar on the planet. Beat text pop. $1.1 trillion in dollar-denominated commercial paper issued by non-U.S. banks. Source: BIS Quarterly Review, March 2024. This isn't theory, it's the setup, because the dollar's strength today is tomorrow's weakness. And the paper they call stable, it's the first domino. So how did we get here? Let's start with the Fed's balance sheet. After years of quantitative easing, the system has become hooked on cheap dollars, but cheap dollars hinge on one thing: confidence. And confidence is a fragile thing. Beat tonal. Take a stroll down Wall Street and ask a trader what happens when the world realizes there aren't enough dollars to go around. You won't get an answer, because the scarier part of the question is the silence that follows. And that silence is already echoing through the data. Morgan Stanley's $42 billion isn't an outlier, it's a symptom. In the span of a single year, unsecured commercial paper maturities swelled from $28 billion to $42 billion. That's a 50% jump in just 12 months. And if short-term funding needs are climbing that fast, what happens when the cost of rolling over that debt spikes? Beat text pop. Unsecured commercial paper maturities, $28 billion, $42 billion in 1 year. Source: Morgan Stanley Sec 10Q 2023-2024. The answer isn't complicated, it's brutal. Refinancing costs rise, earnings dip, share buybacks get scrapped, layoffs start, and the dominoes begin to tumble. But here's the kicker: none of this shows up in the stock market yet, because the market is still pricing in the illusion of stability. The Fed says everything's fine, the Treasury says the dollar is strong, the ratings agencies say the paper is safe, but the numbers tell a different story. $1.3 trillion in commercial paper. $1.1 trillion of it sitting outside U.S. borders. $42 billion due in 90 days at a single firm. And the system, it's a house of cards built on a foundation of rolling over debt. Beat visual. So what happens when the music stops? Well, the IMF warns that a 5% stronger dollar could trigger a 3% contraction in global GDP. That's not just a recession, that's a global seizure. Emerging markets would buckle under debt they can't refinance. Central banks would scorch reserves trying to prop up their currencies, and firms like Morgan Stanley, they'd be forced to choose: raise cash at punitive rates or face a liquidity crisis. And that's when the panic ignites. Because the paper they call stable, it's about to get a lot less stable. Beat Zoom. So the question is whether this system can hold. It's how long it takes for everyone to realize it's already cracked. And once that happens, the dollar's strength won't matter. Because when liquidity dries up, the only thing left is the bill. Magnifying glass tilted left: independent research, not financial advice. So picture this: the commercial paper market is like this high-speed short-term cash machine. Corporations and big financial firms basically hit up investors for quick loans, anywhere from 1 day to 3 months. They sell IOUs at a discount, investors pocket the difference when the notes mature, and everyone walks away happy. The catch: No collateral means issuers gotta keep those credit scores spotless and maintain a steady flow of cash from money market funds and banks. And when banks start tightening the purse strings, commercial paper suddenly looks way more appealing than revolving credit lines. Now check out the latest Fed data. U.S. commercial paper outstanding clocked in at a cool $1.3 trillion in Q2 2024, with financial companies ramping up issuance by 8% year-over-year. Source: Federal Reserve H3 release. That's not just growth for the sake of growth. It's a flashing neon sign that short-term funding needs are spiking as bank credit dries up. Take Morgan Stanley's Q1 2024 10Q for example. It revealed $42 billion of unsecured commercial paper maturing within 90 days. That's a 50% jump from $28 billion a year prior. Source: SEC 10Q. Suddenly, the rollover window shrinks, and everyone from the firm to its counterparties is scrambling to line up cash before the music stops. But here's the thing: this pressure isn't some isolated U.S. problem. The BIS dropped a bombshell in its March 2024 quarterly review, reporting that non-U.S. banks issued a whopping $1.1 trillion in dollar-denominated commercial paper in 2023. That's a massive exposure, tying foreign balance sheets to the health of the U.S. short-term market. When a foreign bank's got to refinance a chunk of its dollar debts, even a hiccup in the U.S. market sends shockwaves worldwide. And just to make things worse, the dollar's acting like it's still 2022, refusing to cool down despite inflation easing up. Reuters pointed out back in May that the greenback's sitting near multi-year highs, keeping foreign borrowers in a never-ending game of dollar-denominated debt roulette. Source: Reuters, May 15, 2024. A stronger dollar means higher costs to service that debt in local currency, leaving less wiggle room for companies trying to roll over paper without jacking up spreads. The IMF even chimed in with a warning. A 5% dollar surge could slice 3% off global GDP by tightening financial conditions and piling on debt service pain for emerging markets. Source: IMF World Economic Outlook, April 2024. But the same squeeze hits domestically too. U.S. issuers refinancing in foreign currency face balance sheet strain, pushing them to lean harder on domestic commercial paper as a lifeline. Here's the wild part: that $1.3 trillion headline number looks stable, almost boring. But dig deeper and you see a market held together by duct tape and hope. Short-dated liabilities are piling up, dollar funding reliance is climbing, and a stubbornly strong dollar is hiding cracks in the foundation. Stability, more like a house of cards waiting for the next gust of wind. Let's break down that fragility. Say banks pull back on short-term lending, the kind that keeps the commercial paper market humming. Money market funds would have to step up, but they're already strapped by liquidity rules. The BIS calls it like it is. Non-U.S. banks already up to their eyeballs in dollar paper would get hammered by refinancing shocks if the dollar keeps flexing. Source: BIS Quarterly Review, March 2024. Those shocks mean higher borrowing costs, which then trickle down to anyone trying to issue new paper. And it doesn't stop there. Those higher commercial paper spreads bleed into repo rates, making short-term borrowing pricier for banks, and eventually tightening credit for the rest of the economy. The $1.3 trillion number, just a snapshot of volume, not strength. This market's survival depends on issuers rolling over debt like clockwork, but right now both bank liquidity and a rampant dollar are throwing wrenches in the gears. So what's the takeaway? The 2024 commercial paper scene isn't just busy, it's stressed. Financial firms are flooding the market, near-term maturities are exploding, and the dollar's acting like it's on a winning streak. Hidden liquidity gaps are lurking beneath the surface, and while everyone's nodding at the Fed's stable label, the fine print tells a different story. Stability here isn't a given, it's a balancing act on a tightrope. Close-up of a ticking clock layered on a crumbling dollar bill graphic. The numbers don't lie. The Federal Reserve says $1.3 trillion in commercial paper is stable. But that's not the picture the market is painting. $1.3 trillion. That's the total size of the U.S. commercial paper market the short-term debt firms use to keep the lights on. And it's growing fast. Financial firms alone pushed out 8% more commercial paper in 2024 than they did the year before. Morgan Stanley's own SEC filing shows $42 billion of its unsecured paper matures in just 90 days, up from $28 billion in 2023. Every single dollar of that has to be rolled over. Every single quarter. Split screen: left side a serene Federal Reserve building, right side a frazzled trading floor with flashing red numbers. But here's the catch: the Fed isn't sweating it, they call it stable. The problem? The BIS says otherwise. $1.1 trillion. That's how much dollar-denominated commercial paper non-U.S. banks issued in 2023. In a stronger dollar, refinancing that debt gets brutal. A stronger greenback means higher costs, and when those costs spike, balance sheets crack. The IMF isn't silent. Its April 2024 World Economic Outlook warns that even a 5% dollar appreciation could shave 3% off global GDP. That's not a forecast, it's a warning flare. Time lapse of a domino effect, each domino labeled with a major bank, global corporation, and emerging market. So why aren't we hearing this on the news? Because the media isn't asking the right questions. Reuters tracks dollar strength but misses the refinancing trap. Bloomberg notes inflation cooling but glosses over the debt wall looming. The silence isn't accidental, it's a filter. Insiders aren't staying quiet. Short-term funding markets are more fragile than at any point since 2008, says a former senior Fed official who asked to remain anonymous. The Fed's own data shows pressure building, but they're treating symptoms, not the disease. Another warning, a 2023 survey of 200 global treasurers found 63% expect a liquidity crisis within 24 months. That's not speculation, that's preparedness. Montage of empty TV news studios with scrolling headlines, dollar strengthens, markets calm, Fed on hold. While the cameras stay on inflation and rate cuts, the real story hides in plain sight, a system addicted to cheap, rolling debt. And when that addiction ends, the fall isn't soft, it's systemic. The Fed calls it stable, the data calls it dangerous, and the clock is ticking. The newest Fed data reveals that commercial paper sitting out there totals $1.3 trillion for Q2 2024, and issuances by financial firms are up 8% compared with a year ago. Source, Federal Reserve. That jump flags tighter short-term funding conditions, a real sore spot for any portfolio counting on ready-made credit lines. Investors feel the ripple right away. Morgan Stanley reported $42 billion of unsecured commercial paper due in the next 90 days, a 50% surge from the $28 billion it held a year prior. Source, SEC filing. Those coming due notes will have to be rolled over while the dollar stays strong and cash becomes harder to find. Zooming out, the global view broadens. According to the BIS, non-U.S. banks rolled out $1.1 trillion of dollar-denominated paper in 2023, leaving them vulnerable to refinancing jolts should the greenback stay firm. Source, BIS Quarterly Review. The IMF cautions that a 5% rise in the dollar could trim global GDP by about 3% by tightening financial conditions and hiking debt service costs for emerging markets. Source, IMF World Economic Outlook. So what does all this spell for your holdings? You can expect higher yields on short-term instruments, yet also brace for more volatility as everyone scrambles for liquidity. Defensive corners, think utilities, consumer staples, and top-tier bond funds usually cling to value when credit stress mounts. On the flip side, high beta stocks and emerging market bets may feel the squeeze as the dollar stays strong. Stay ahead of the curve. Keep tabs on the Fed's commercial paper data, watch the upcoming maturity windows, and eyeball the dollar index every day. Those who tweak allocations today can cushion their portfolios against a tightening credit cycle before it ripples into wider market stress. If you're after deeper analysis and hands-on risk management tools, go ahead and hit subscribe. We'll dissect the data, run scenario models, and arm you with tactics to safeguard your wealth as the monetary landscape shifts.